Hello and welcome back. When it comes to the tax free savings account or the registered retirement savings plan, more commonly known as TFSA and RRSP, most people do not fully utilize the benefits of these accounts. In this video, I'm going to highlight how I have been maximizing contributions to these accounts using covered call ETFs. Maximizing benefits of these accounts is quite important because the last thing we want as income investors is to get taxed on the income we receive when there is a way to save on it through these awesome accounts. The first obvious step is to maximize your TFSA contributions. How much money you can contribute will depend on how much contribution room you have available. This in turn depends on your age. You become eligible to start a TFSA as soon as you turn 18 years old. Every year, the CRA, or the Canadian Revenue Agency, provides a contribution room, the maximum contribution limit for that particular year. Every subsequent year after you turn 18 years old, you may keep adding the contribution room announced by CRA to figure out how much total contribution room you have available. Here is a table showing the contribution room for every age from 18 years onwards as of 2025. Based on this table, we can see that the maximum contribution room anyone could have is up to 102,000 Canadian dollars, which quite honestly is a fairly good amount. If you actually manage to maximize your TFSA and invest it in popular Canadian covered call ETFs like HYLD, USCL, or EQCL, you could start receiving monthly income in the range of 900 to 1000 Canadian dollars completely tax free. This is because any income you receive in the TFSA account is not taxed. That is the major benefit of this account. But is it possible to increase your contribution limit even beyond your maximum available limit? The answer to that question is surprisingly yes. Once you have maximized your TFSA, the next step is to start withdrawing the income that you receive. TFSA is designed to keep track of your withdrawals, which get added back as contribution room the following year. So let's say if you withdrew $12,000 in 2024, then in 2025, your total contribution room will be $19,000. This includes $12,000 added back from the previous year and $7,000 contribution room given by the CRA for 2025. Now you can start recontributing to the TFSA until you reach the maximum limit and repeat this cycle. Now, the obvious question you might ask is what to do with the money you withdrew in 2024? Do you just keep it lying around in a savings account? The answer to that question is no. You contribute that in an RRSP. The RRSP is designed to be a retirement account, and ideally, you're meant to withdraw from it only when you turn 65 years old. This often discourages people from making large contributions to the account early in their life. However, later in this video, I will explain how you can withdraw from this account without any negative tax implications. But for now, let us take a look at the most positive aspect of making RRSP contributions, which is tax deduction. In our example, if you contributed $12,000 in the RRSP account in 2024, then the following year, when you file taxes, you will receive a tax deduction. The percentage of deduction you will receive will vary depending on the province you're living in. But for the sake of simplicity, I will keep it at 20%. So for the year 2025, with all else being equal, you should receive a tax deduction of $2,400. This you can immediately contribute to your TFSA account. So if we do the math, the actual contribution you need to make out of your savings to maximize your TFSA account in 2025 is $16,600. Please note that the money you contribute in your RRSP could also be invested in covered call ETFs. And just like TFSA, income received in an RRSP account is not taxed. So, in both accounts, you're receiving income from these ETFs completely tax free. Once again, if you run out of contribution room in TFSA, you could go for another year of making RRSP contributions and TFSA withdrawals, and then return to making TFSA contributions the year after that. I have been using this method to maximize my TFSA and RRSP contributions, and it has worked great so far. One obvious question that arises here is that what if you run out of contribution room for both TFSA and RRSP? To that, I would say that it is highly unlikely you will run out of contribution room for RRSP. The contribution room for RRSP is calculated at 18% of your earned income. This can be carried forward indefinitely, and since most people do not make consistent contributions to RRSP, even over a 3 to 5 years period, this quickly adds up to a significant number. More importantly, in the method discussed in this video, the majority contributions are going towards TFSA. So, unless you win a lottery, it is quite unlikely to run out of RRSP contribution room using this method. Now, let us address the lingering question of making RRSP withdrawals. Any withdrawal made from the RRSP account counts as a regular income and gets added to the active income you're receiving. For example, your salary, and has the potential to increase your tax bracket. So, the best time to withdraw from the RRSP account is when you're not receiving any active income. It is important to note that there is no restriction on making withdrawals from the RRSP account before the age of 65 years. The only problem is that most people are receiving active income in the form of salary up to the age of 65. So, making withdrawals is considered risky during this time because it has the potential to increase your tax bracket. But as income investors, we are planning to retire early. As soon as you have accumulated enough passive income from these investments, where it is good enough to replace your active investment, then that is the ideal time to start making RRSP withdrawals. The ideal amount and time frame needed to reach this step will vary from one person to another. For some people, $4,000 a month might be a good enough amount. Others may need up to $10,000 a month to retire. With some discipline in spending habits and consistency of investing, it is possible to reach these figures as early as age 40. Once you have reached this stage, where all your income is coming from passive investments, what you will notice is that despite making RRSP withdrawals, your overall tax bracket does not change because the taxable income is actually low and keeps you in the lowest tax bracket. Let us better understand this with an example. Let us say Tim has been investing in covered call ETFs all his life, and now he is receiving an income of $4,000 per month from all his investments. This is good enough to replace his job income, where he is receiving $48,000 annually. Out of his total passive income, he receives $2,500 in his TFSA account. So there are no taxes on making those withdrawals. But the remaining $1,500 are coming from the RRSP account. Since Tim is going to quit his job, he understands that the withdrawals from RRSP would not increase his tax bracket as it will be the only taxable income since he is no longer receiving any job salary. So the question is how much tax he would end up paying if he withdraws that $1,500 every month from the RRSP account. To do this calculation, we must first understand how taxes are calculated on RRSP withdrawals. Every time someone makes a withdrawal from RRSP, a withholding tax is applied by the broker at the time of making the withdrawal. This withholding tax is a form of prepayment on the total applicable tax at the end of the year. The percentage of the withholding tax depends on the amount you're withdrawing. This page shows us the tax percentages corresponding to the amount withdrawn. In our example, Tim is going to withdraw $1,500 every month, so he would end up paying a 10% withholding tax for every withdrawal he makes. If we do the math, over 1 year he would end up withdrawing $18,000 and would end up paying $1,800 of withholding tax. But the withholding tax is not the total applicable tax for the whole year. The actual applicable tax will depend on the province. In this example, we are assuming that Tim lives in Ontario, so the provincial tax will be 5.05%. In addition, everyone in Canada has to pay the federal tax, which would be at 15%. So the total applicable tax on RRSP withdrawals of $18,000 will be $3,609. From this, we subtract the $1,800 of withholding tax already paid out. So the tax applicable at the end of the year would be $1,809. This is actually quite good. Remember, in addition to the $18,000 from RRSP, Tim is also receiving a total of $30,000 annually from the TFSA withdrawals. So he's actually paying $3,609 tax on a total income of $48,000. This gives us a tax rate of 7.52%. In contrast, if Tim was receiving the same income of $48,000 through a job in the form of a salary, he would end up paying a total of $9,631 in taxes with a tax rate of 20.06%. So Tim is not only receiving passive income, but also saving over $6,000 in taxes. The method I have highlighted in this video will result in similar tax savings even if you're aiming for more than $48,000 of annual income, because this method enables higher contributions in the TFSA, where the withdrawals are completely tax free. With that, we come to the end of this video. The method I have highlighted in this video for maximizing TFSA and RRSP contributions is just the approach I use. Let me know in the comments section if you're aware of any other techniques for maximizing contributions to these accounts. As always, the information and insights shared in this video are based on my research and express my opinions and do not count as investment advice. If you found some value in this video, don't forget to like, share, and subscribe. I will see you guys in the next one. Thanks for watching.